Folks, well, here's the capstone, video number 3 of this very interesting discussion. We talked about stop buying real estate, right? Just put stuff in treasuries. Number 2, we highlighted how values could collapse 50% very, very quickly. Now we're going to talk about how this real estate disaster may unfold. And we talked about at very end of video number 2 about some buildings maybe being sold for land value. We've talked about a notion of extend and pretend. So I think there's some more kind of education we should be sharing with the audience, but there is a lot of pain. And oh, by the way, we've been telling you it's coming and it's starting to show up. So Jonathan, I don't know where you want to start, but I think we just need to highlight for folks that there's some real pain coming in the commercial market.
Well, yeah, I'm sorry. Somehow I missed the train of thought here. So, because we talked about a lot of pain in the last, we talked about a lot of pain in the last segment. What's the pain you want to talk about right now?
I want to just educate people on notions, because let's talk about extend and pretend first, right?
Okay.
Because again, we're an owner of an asset. We have debt on that asset. There's something in the contract or loan that says you have to refi the asset. You have equity, but you don't have enough equity to refi, right, and you're not in a position to do a capital call. One thing that may happen is what was called extend and pretend a decade ago, which basically means, in my language, we'll give you another 12 months. We'll see where we're at. What is extend and pretend, and how might that work?
Yeah, so I mean, I think you summed it up pretty well. I think in the commercial space, the way this would work, we talked in the last segment, we went through the math about how the value can drop. Now, when you do a refinance in commercial property, you are usually limited to about 70% of the value of the asset, right? Now, this shouldn't matter to you, because if you in a typical situation, you go in at 75% LTV, you hold it for 5 years, your rents have grown, your NOI has grown, your value should be higher, so that by the time you refinance at 70%, you actually should be at least at that 75%, be able to cover what's left. And plus you've amortized some of your debt, right? So you shouldn't have a problem covering the
you should be money
balance.
good, if you will. Yep.
Yeah, exactly. So, and you might even be up, somewhere around 80 or 90% of the previous value, right? So you might even be able to take some cash out, right? So that's the way it's supposed to work. The problem is, if you bought at the top and cap rates have gone up and your value has gone down, well, now, even if the bank was willing to give you 75%, that building might be underwater, right, in terms of value. And so what you're going to have to do to get, to avoid foreclosure is to, pump up some more equity, right? To get essentially pay, buy down the amount of loan, because you're going to get only, 70% of whatever the thing is worth now, right? So you're going to have to come up with the rest. Right now, there may be situations where that's not possible, and the bank is going to look at this and say, well, look, we don't want to foreclose, because then we're going to have to realize this loss. Right. We know the property is now only worth, it's worth less than the balance of the loan. Right. So we don't want to foreclose. What we would rather do is hope that things are going to rebound in the next 12 months, so that at that time we can refinance you out and we'll be made whole, or at least, we will,
the loss will be less.
The loss will be less, or if we foreclose and sell, we'll make our money back or whatever, right? So they just want to kick the can down the road in the hopes that, things will be better. So that's kind of how extend and pretend works. But, banks are only willing to do it for so long.
Yeah. It's a year, it's an 18-month thing. That's the actual thing that I think will happen the most is something we haven't discussed yet. So I'll put it here is, I actually think banks are going to switch operators a lot. Right. I think the banks, what's going to ultimately happen is banks are going to say, here are my 10 rock stars. Everybody else isn't. And they're going to create sweetheart deals for the top 10. And the others are going to lose. They're just like, you're not one of the top 10. You're the problem. We're going to switch. We have to show our investors we're doing something. So I think they're going to switch operators a lot. What do you think?
Well, look, if the problem is just that interest rates changed and cap rates moved, and the operator and the place is operating fine. You know, they're at 95% occupancy where they should be. You know, they're at the proper expense ratio. The problem is just everything moved in the wrong. The world changed rather than the asset.
The world changed quickly. Yeah,
I don't think banks will replace operators in that situation, because I mean, who are they going to replace it with? You can't. They're already performing as well as could be expected. They're not going to get somebody in there who's going to miraculously do better. But I think that you may though see it where assets are clearly underperforming the market. Yep. You may see banks at that point saying, okay, we're bringing somebody else in. But the question really is like, well, who do they bring in? Right. And, you know, so that's going to be an issue. I think another thing that, you know, there's been some discussion about, not so much banks, but there's been a lot of discussion about preferred equity coming in to rescue deals, right? And supplying that extra capital. Now, I am a bit dubious about this notion for a couple of reasons. Mainly being that I don't think private equity has any interest, or preferred equity, I'm sorry, the preferred equity lenders have any interest in coming in and putting in money into buildings that are now worth less than the outstanding debt, right? They don't want to be behind. They don't want to be behind, you know, in second position behind a lender who's underwater, right? So because there's nothing left for them there. That doesn't make any sense at all. But to the extent,
do you think that banks could sell their note or their position for pennies on the dollar? Maybe
they may. I think that there'll be some banks who are, if they're underwater, they'll just say, we'll just sell it for what we can get, and you know, and then the next investor will just foreclose and have the asset cheap. I think you'll see a lot of that. I think the other thing that is going to happen too, and it's going to make a lot of LPs very unhappy, is that, you know, private equity, you know, private preferred equity lenders may come in, and basically the LPs are going to get crammed down, right? Exactly. The LPs will just basically get wiped out, and so
they'll be left on it, but it'll be such a high rate of return that their chances of getting anything are zero.
Yeah, they'll never, you know, if they get, they'll probably wind up getting, you know, pennies on the dollar that they originally invested
of the equity, let alone a return.
Of the equity. Yeah. So this is going to be, there's going to be some pain, and you know, the ripple effects of that are going to be that a lot of LPs are going to get burned, and they will never invest in a syndication again, right? So those kinds of capital sources are going to, there's going to be a long-term impact on the pricing of multifamily because of that, right? The institutions will take their lumps. They'll come back in because they'll understand that, like, hey, look, this is an asset that is good for, you know, what happened before. We're buying at today's prices, you know, it's all good for going forward. But a lot of LPs will be scarred, and they'll be like, you know, I lost 50,000. I'm never doing that again.
Yeah, it's funny. So, I don't know if you watch a podcast called the All In Podcast. It's a tech and venture capital podcast. So it's something I watch or listen to over the weekends. And there's a gentleman named Chamath Palihapitiya. Anyways, it doesn't matter who he is, but basically he's talking about the same kind of pain in the VC world, right? There's been a lot of LPs that came in the last couple of years that are just going to get washed out, and they'll never come back. And I think there's a lot. I think when money's free and risk is zero, people do stupid things, and there's a reset coming. And Chamath is talking about the VC world. Perhaps he thought it would take 3 quarters to kind of reprice. He's like, it might take 3 years to reprice because of extended pretend and people, you know. So I think the same thing in commercial. I was originally like, hey, 2023, 2024 is the time to go shopping. Now it's probably 24, 25. But I'm excited. But there's a lot of pain coming in this space.
Yeah, and I think that, you know, it's going to be like after the great financial crisis, when I first got into the business. It was hard to find deals because of a lot of different things. Like, it was hard to find deals that made sense because, you know, you're looking at like what you would pay, and the seller's like, well, I need 2007 pricing for this, right? And even though they were completely like unrealistic, but a lot of them were just they couldn't sell for less because they couldn't repay their debt, right? And the banks were just letting them, like you said, kind of kick the can down the road and not foreclose on them because they didn't want the assets. And it took several years for prices to kind of start to reset, for enough for sort of foreclosures to work through the system, that, you know, people, you know, like that sellers understood, like, well, this is what the thing's worth, right? And so, you could see that again.
Yeah. And then, you know, the last thing that kind of ran out the pain we talked about in video number 2 is there will be some people that just hand the keys back, and there'll be some assets sold for land value. And, you know, some pretty marketable discounts. We talked about one theoretical office building that had an NOI of $1 million that went to 500, that was worth 25, that was worth 8.6. I mean, it's going to happen.
Yeah, I don't think that you'll see. I mean, multifamily assets that are stabilized are not going to sell for land value. I mean, but the issue with, but they may sell at a discount to even their debt, right? I mean, you may see those notes being traded for less than the face value of the note, because the value is dropped if the cap rates go up too much. Oh, and so one thing I wanted to mention in one of these segments I forgot about, when we were talking about so the relationship between interest rates and cap rates, and, you know, one of the things that happened over the last few years, one of the reasons I sold my portfolio, was that there historically has always been not just, you know, a spread between the risk-free rate of return and like sort of a class A building, which is the next, you know, the lowest level, right? But there has traditionally been a spread between A, B, and C properties, and then a spread between A, B, and C markets. So if you think of like a 9-box grid where you've got markets on one axis and you've got property class on another, you know, up in one corner, you've got, you know, an A asset in an A market, right? And at the other corner, you've got a C asset in a C market, right? And what you used to have is kind of like, you know, an A asset in an A market multifamily would be trading at a 4 cap, right? Like in New York City. So people would be going in at low leverage, right? Probably 50, 60% leverage, because the interest rates were higher than the cap rate. So they had negative leverage, but they were willing to do that because they had strong rent growth and those assets were held their value and very low risk. At the other end of the spectrum, like a C asset in a C market would be like trading at an 8 or a 9 cap, right? Yeah. But what happened was, in all the craziness over the last 2 years, that whole thing shrank, right? And it all converged upwards towards that AA, right?
Yeah,
and so
I saw that in my market.
You were not seeing a risk premium for those C assets. And the craziness was that people were like, well, hey, I'm willing to pay a super compressed cap rate on a C property because I'm going to do a value add, and I'm going to add so much, you know, I'm going to raise the rent so much. And yeah, when it works, it worked great, right? People made a lot of money doing that. The problem is, as always, it's the people who get caught when the music stops, right?
Exactly.
That are the ones that get their head handed
rushed.
to them. And yes, and when people convince themselves that the music was never going to stop, as happens at the top of every hot market, right? There's always people who are like, this is going to go on forever. And those are the people who are really going to get crushed. And what you're seeing now is you're seeing the return, not just the return of the risk-free rate of return that you have to compare all your investments against, but you're seeing that expansion again of people saying, well, hey, you know, a C asset in a C market should not trade at the same cap rate as an A asset in an A market, right?
Exactly.
And so you're seeing that the normal expansion coming back, where people are starting to say, hey, this has more risk than that, and I'm not going to pay as much for this as I will for that. And so that's where we are.
Yeah, it's going to be a lot of fun there. This is going to take a while, folks, to unravel. It's something Jonathan and I have talked about. You can look at his playlist. It's just Jonathan Twomley. You're putting on an awesome event in Vegas that I'm excited to be attending. I've paid up for the VIP access. And oh, by the way, my wife is coming because she's excited about the opportunities ahead of us. Why don't you tease that event? Where can people find out more about it?
Well, so listen, I'm going to tease something else right now, which is that just for this community, we are going to do a flash sale on this event. So we are going to have, so this is going to be a great event. It's in Las Vegas at the Link Hotel. This is April 26th to 28th, next month. We've got a fantastic lineup of speakers who are going to be at this event. Michael has said he's going to be there. Michael has kindly said, what will you do with your All
I would
right,
love to.
folks.
I'd love to do an event, a coffee, a lunch, something just for one rental at a time fans that are there. If anybody shows up, I'd love to be there.
So with that on the table, what we're going to do is next week, we're going to do a flash sale where I'm going to give you guys a very, very short-lived discount, but a really nice discount off this event that will include not just a basic ticket, but you can apply the discount to the VIP upgrade as well. And that'll be on tap for next week. So be sure to tune in to get the discount code, and we'll tell you where to go to get the tickets. And hopefully we'll see a bunch of you in Vegas. Yeah. And look, Michael, if you know, I'll be pretty crazy with the conference, but if I have the opportunity to stop by whatever you organize for the members, I will absolutely stop by myself and say hi. So
awesome. Well, I look forward to it. Look forward to the audience coming. Again, Olivia does not come to a lot of events, but she sees this part of the market being something we get into over the next several years. So Jonathan, we look forward to it. Thanks, buddy.
Absolutely. See you then.